Good evening. Good evening. I don't know if you can start, please. I think we have enough in the audience, and I have actually shared it.
Good afternoon, everyone. Apologies for the delay. My name is Aderoju Akimbo. Trust you're having a good day. I will be your moderator for this session. I welcome you to our first webinar session of the year, which is going to look at the highlights of the Q1 2022 and the outlook for Q2. Despite the fact that the QC has just commenced, it has become imperative to know what the future holds amidst economic challenges globally, locally, which is evident in the rise of energy prices, continuous increase in inflation, vis-a-vis national grid collapse. We begin to wonder what and where opportunities lie, taking into cognizance political instability come pre-election year. All this forms the basis of our discourse. To do justice to this is our able presenter, whom I'm very proud to introduce. He is a renowned banker of many years, chairman of Fidelity Pension Managers and Virgin Forest Energy Limited. He is a facilitator at the Lagos Business School and the Financial Institute of Training. He is also a fellow of ICANN and Chartered Institute of Taxation of Nigeria. He is the honorable senior member of the CIBN. Currently, he sits at the ends of affairs of one of Nigeria's leading investment banking companies, a financial supermarket, talking about Cowry Asset Management Group, as the managing director in person of Mr. Johnson Chukwu. Good afternoon, sir. We're happy to have you here, sir.
Good afternoon. Okay, just a second. I need to close the dialogue so that we can.
Thank you, sir. Thank you for being here today, sir. Before we go right into the presentation, I would like to set the ground rules. Please, there's a chat box at the bottom. Should you want to comment or for any interaction, kindly make use of the chat box. Should you have questions, please make use of the Q&A box. I, for one, am looking forward to learning a lot and taking down a lot of notes. So I hope you will do the same. Thank you. If the presenter is ready, then we can start immediately, sir. I leave the floor open for you, sir.
Okay, good afternoon, good evening, everyone. I guess many of you can hear me. I just go straight to the topic of our conversation. We're going to be speaking on our local and global and local macroeconomic environment. We first look at the global environment. Of course, you always know that no country is an island today. Things you feel will not affect you, obviously, when they begin to happen, they certainly have to affect you. I mean, we're living in a global world where the whole economies are now interwoven. So I will first speak on the global economic environment. This year started with COVID-19 variants which was called Omicron. It actually started towards the end of last year. And eventually, by the beginning of this year, there were a lot of apprehension that the global economy could go into a fresh lockdown. If you recall, December last year, UK banned air transport between, banned Nigerians or Nigerian passengers, or those who are transited through Nigeria from entering UK as a result of fear of Omicron. Good thing, by the time we got into this year, the concerns about Omicron seem to have eased. I always say this, that like Omicron came to kill COVID, because what happened was Omicron had a very fast infectious rate, but was mild in terms of effect. And so we saw a reduction in the concerns about COVID, which led to some restoration of economic recovery. But unfortunately, as the global economy was just about shouting hooray from the moderation of concerns about COVID, we had a war that evolved, that started in Europe. The first war in Europe between European countries more than 50 years. The war involving Russia. Russia invaded Ukraine on the 24th of February 2022, thereby threatening global peace. Of course, we know the entire Western countries, the US, Western Europe, and some countries in Eastern Europe frowned at the war and began to provide some level of support to Ukraine in the war effort. That had a direct impact. The start of the war had a direct impact on the global economy. Like I said, many Western countries had their sympathy for Ukraine and imposed sanctions on Russia. The impact of sanctions in Russia was that a lot of commodities, we saw a spike in commodity prices. Russia, as you may know, is the largest producer of wheat. With Ukraine, they produce about a quarter of the world global wheat production. Russia is the second largest exporter of crude oil, the third largest producer of crude, the third largest producer of coal, and the biggest exporter of natural gas in the world. So Russia is it's at the linchpin of global economic supplies. And the Western countries imposed some form of sanctions against Russia. The sanction did not get into the energy sector because no sanction was imposed on importation of Russian oil by the Western countries other than US. No sanction was imposed on its importation of gas, natural gas from Russia, though Britain said they will win themselves of Russian gas in the next 30, by 2030. But the reality is that the Western economies also recognize that imposing sanctions on importation of wheat, of energy products from Russia would also damage their economy. But nevertheless, we saw a spike in crude prices as a result of the war. We've seen crude price trade above $100 since the beginning of the war. We've seen the price of natural gas almost double since the beginning of the war. And we've seen the price of wheat also increase astronomically since the beginning of the war. This all have impact on many countries. So we have an increase in energy prices across the globe. We have increase in food prices in most countries of the world. Of course, all these things have dovetailed into increase in inflation rates globally, though there were already inflationary pressures in many countries as a result of excess liquidity occasioned by expansionary fiscal and monetary policies during the COVID-19 era. As central banks were about unwinding their expansionary monetary policies, this war started and then led to a spike in commodity prices, energy prices, as well as food items. So we've seen a country like wheat, like Turkey, with an inflation rate of 61%. Like I said, some of them already had underlying inflationary issues and economic issues. Spain, with an inflation rate of 9.8%, We saw a 5.9% inflation rate in the month of February in UK. Sorry, in the European zone, you saw a 5.9% inflation rate, and the UK about the same rate. And then you have US inflation rate has gone as high as 7.9% in the month of February. Of course, Nigeria's inflation rate reversed from a decline of where it dropped to 15.6% to now 15.7% in the month of February. And it's expected that these inflationary pressures will continue. The European Union is projecting an inflation rate of 7.5% in the month of March. Like I said, the energy costs, increase in energy costs have impacted on commodity prices, on food prices or consumer goods. As I said earlier, Russia and Ukraine account for a quarter, 25% of wheat production. Beyond that, they are also the largest producers of, between them and Belarus, they are the largest producer of fertilizer. And the fertilizer that is produced in Russia, Belarus, and the Ukraine feed many markets, many major food producing countries like Brazil and other Latin American countries. So this has led to a spike, a shortage of supply of fertilizer in those countries, and will obviously manifest in food production in the coming months. So you should expect that food production will weaken, and if food production weakens, food inflation will increase further, and that could also, there are actually speculation that you could see some level of starvation in some countries, particularly in North African countries that have wheat as a major staple in their food. Yeah, as you may know, the North African countries, 90% of their trade with Russia is basically on food and food items, particularly wheat. And you may know our North African brothers are many of their meal are largely bread and related wheat products. So there's huge concern that, in fact, I have seen a report that said, look, we can't rule out the possibility they could have civil unrest in North Africa as a result of the war in Ukraine. I had mentioned earlier that the US inflation rate had gone as high as 7.9%, the highest in more than 40 years. Of course, the Federal Reserve Chairman has said that, look, they cannot sit by and watch this trend to continue, and that we're going to step on the brakes and increase rates. So in the month of March, at the Federal Reserve Committee meeting in the month of March, they increased the rate, the benchmark rate, by 25 basis points. It may also interest you to know that the Bank of England also increased the benchmark rate by 25 basis points. We have always said that once the US starts unwinding the expansionary policies, then you will see the Western economies also follow suit, particularly Britain under the European Central Bank. The simple reason why that has to happen is that if rates are increasing in US and the UK and the European zone are not increasing their rates, liquidity will flow away from UK and Europe and flow to the US. And to avoid that, this central bank will also largely mirror what the Federal Reserve Bank is doing. So the UK government or the UK Central Bank, Bank of England, equal increase rates in the month of February by 25 basis points. At the local level, the much awaited removal of petroleum subsidy was aborted as a result of political intrigues when the presidency announced that the removal has been deferred by 18 months. But immediately following that, as it was a conspiracy, but I doubt if there was any form of conspiracy. We saw arrival of contaminated petroleum products into the country, and that led to huge shortages. As we speak today, in several locations, the price of PMS of fuel has not normalized to 165 naira. There are still many up-country locations where the price is still going for 180 naira to 200 naira. It's largely in Lagos that you can go driving and get at 165 naira to a liter. So, and this all have transmission effect on inflation rate. If you look at the inflation figure for the month of March, you will observe, for the month of February, you'll observe that food inflation moderated while core inflation increased. And in the previous years, the previous months, the past 2 years, the pressures have been coming from food inflation. But now we saw a moderation in food inflation and an uptick in core inflation. And this may also further reflect when the March inflation figures come out. Because like I said, we are seeing several channels of transmission as it relates to inflation. Fuel prices was quite elevated in the month of March. We've seen all energy supply sources, diesel, PMS, all had increases. And when they are increasing those major commodities, you will also see an impact on transport costs and other components of household consumption. The issues about the increase in energy costs, particularly fuel and diesel, beyond the fact that we had contaminated fuel, then because diesel is deregulated, and then there is a major supply challenge of taking a crude product from Russia to Western refineries in Amsterdam, where a lot of refineries are situated for refining. So we've seen a shortage of diesel supply globally, and that has led to a major increase in diesel prices. Of course, diesel prices have direct impact on productive activities because there are a lack of sufficient energy supply from national grid. Most manufacturing enterprises and households, including corporate offices, rely on diesel for their business operations. So we've seen a major uptick in the price of diesel. This will have negative impact on the cost of manufacturing, cost of production, logistics, and transportation. And then the fact that we took a political decision to suspend the removal of subsidy means that the government has to borrow more. Because the government had actually made the initial provision of 455 billion naira as subsidy payment up to the month of June, hoping that they will take out the subsidy in July. But with this reversal of costs and the uptick in crude prices, which translates to increase in imported refined petroleum products, the government had made an additional provision of 2.55 trillion naira as subsidy payment. In fact, the Minister of Finance had actually said not too long ago that even with the 3 trillion now budgeted for subsidy, they are not sure it will be enough given the current price, because at the time that budget was done, the increment was done, our crude price was about $70 per barrel, but about $100 per barrel, which is a more than 30% increase from what it was when the 3 trillion naira subsidy provision was made. It then means that the 3 trillion naira will no longer be enough to meet that commitment. So the minister said they are speaking with that the government was talking to, or the executive was talking to the National Assembly to ensure that the amount that the government spends on subsidy does not exceed the 3 trillion naira. What this implies for your records is that along the line, in the course of this fiscal year, the government may need to increase the price of PMS to absorb, for the consumers to absorb the further increment in the landing costs as a result of the increase in crude prices. But the key thing is that with the borrowing, the additional provision of 2.55 trillion naira means that the government, the budgeted subsidy, the budgeted deficit of 6.9 trillion naira, 6.99 trillion naira will not be exceeded by about 2.5 trillion naira, assuming the government is able to achieve a revenue projection of about 10 trillion naira. So if it does that, remember that the budget was predicated on a 17 trillion naira expenditure and about 10 trillion naira revenue. Last year, the government had achieved about 6 trillion naira in revenue. But this time around, they're budgeting about 10 trillion naira in revenue and expenditure of 17 trillion. So when you add the additional provision for subsidy, you will have an expenditure profile about 19.5 trillion naira. So in the absence of any further increase in revenue, or should the government fail to achieve is budgetary revenue, then the deficit will certainly exceed 7 trillion. We should be talking of something like 10 to 11 trillion naira deficit, depending on how well the government goes in achieving its budgetary provisions. Then still on the local economy, we've seen a worsening of energy supply in the country. Tayo, maybe when I finish, you can make your points. We've seen you can ask your questions. We've seen a further worsening of the energy supply in the country. We saw a 2 times of national grid collapse in the month of March. And we know the impacts of energy supply or energy power outage in Africa. According to the World Bank, in Sub-Saharan Africa, for every 1% increase in power outage in terms of hours, there is an associated 2.86% decrease in gross domestic product. Of course, this will translate to a loss of about $28 billion in GDP. Because what happens that when there is, like I said earlier, virtually all manufacturing outfits in this country are relying on self-generated power, which are largely fueled by diesel. Apart from the few that are scattered in Lagos that having access to natural gas supply, most productive activities outside Lagos rely on diesel as energy source. So when you have an increase in diesel cost, it's either they shut down. In fact, I've seen in the recent week or so where operational activities have been stopped because they couldn't even get diesel to buy, not just at the higher cost, but they couldn't even get to buy. Of course, this will lead to a cutback in GDP performance or in the productivity. The key thing we also must not fail to recognize that with an increase in government borrowing, with an increase in budget deficit, it then implies that the government will borrow more. As we speak, we're already talking about 39 trillion naira in federal government debt, over 39 trillion naira in federal government debt. And then it's expected, there are projections that we could get up to 50 trillion in federal government debt. So all this will lead to further pressure on debt service. I had mentioned earlier that inflation rate has reversed, dropped in the month of January, but went up again in the month of February, particularly pressured by core inflation instead of food inflation. And this trend is likely going to be sustained when we look at the figures for March, which will come out in a couple of days from now. The Standard Reserve will continue to come under pressure. The interesting thing and unfortunately we've witnessed in the country is that while crude price has gone up, ordinarily we should be talking of a Ukraine war windfall. But unfortunately, our crude production has actually plummeted, and we'll see living witness situation whereby the country is struggling to even achieve a 1.5 million barrels a day, despite the fact that our OPEC quota for the month of March, April is about 1.728. For the month of March was 1.728, and then for the month of April was 1.745 million barrels a day. There is a very much chance that Nigeria will be able to achieve a 1.745 million barrels a day in the month of April. So what we are witnessing is that while crude price has gone up, we're not getting the benefit of an increase in crude price, but we're also suffering the cost or the pain of a non-oil producing state or country, because we're importing virtually all our refined petroleum products and we're buying them at current market prices, whereas we're not producing enough to compensate for the increase that we're paying for the refined petroleum products. So this is like what they call double whammy for the country. And that has reflected in consistent decline in our foreign exchange reserve. We saw the foreign exchange reserve drop from $40.21 billion on January 25th to $39.44 billion on March 17. It dropped about 2.66%. Then on interest rates, We saw the Monetary Policy Committee at the last meeting last month. They kept all the benchmark rates unchanged. Cash reserve ratio 22.5%, liquidity ratio 30%, and then monetary policy rate 11.5%. The key thing is that they are dealing with two hydra-headed challenges, or what they call a quagmire that the Monetary Policy Committee have been facing. You are dealing with, on one side, on weakening economic growth rate or economic recovery. If you look at the GDP performance in the last 4 quarters, you will observe that in the second quarter of last year, the GDP grew by 5.01%. In the third quarter, it grew by 4.303%, a decline from 5.01%. And in the fourth quarter, it grew by 3.98%. So we're seeing a tapering in the growth rate, though the growth is still positive. Of course, we ended the year with a 3.4% GDP growth rate. But you have to recognize the fact that the economy actually contracted, and that the growth we saw in this last year was partially to partially offset the decline we saw, or the contraction we saw in 2020. So looking at the macroeconomic environment, one, this Monetary Policy Committee had to decide whether to reduce rates to spur economic growth at the cost of higher inflation rate, higher exchange rate pressure. We've talked about the exchange rate challenges we're having, that we're not producing enough crude. Even what we're producing is coming from what they call production sharing contracts, which are produced largely in the deep offshore, where the fiscal arrangement is such that the producer, the international oil companies, are the one who get the chunk of the revenue from such deep offshore productions. So even if, as we're doing about 1.4 million, 1.5 million barrels a day, the share of the Federation on that production side is not as huge as it would have been if we're producing from shallow offshore or onshore assets, which many of the oil companies are actually relinquishing, selling off because of heightened level of insecurity. So the Monetary Policy Committee, at the end of the day, erred on the side of caution to keep rates at current levels. We were just talking about the GDP figures, that the GDP grew about 3.4% last year. That's the best it has done since 2014. If you recall, in 2015, the GDP grew by 2.79%, only to collapse or contract by 1.58% in 2016, and then grew again, recovered to by 1.91% in 2017, and 2018 it grew by about 2%, and in 2019, in 2017 it grew by 0.82%. 2019 it grew by 1.91%. 2020 it grew by 2.7%, only to go back and contract in 2019 it grew by 2.7%, and by 2019 it contracted by 1.92%, and 2021 we are recording a growth. We recorded a growth of 3.4%. So if you take the average GDP growth rate in the past 6 years or 7 years, you will end up with a growth rate of less than 2%. But remember, the population is growing about 3%, and that will now explain why we're having increase in level of poverty, increase in the level of unemployment, worsening of the standard of living of in the country. The World Bank said recently that 4 out of every 10 Nigerians are living in abject poverty. And the World Poverty Clock said about 98 million Nigerians are living below poverty line, because part of it that GDP cannot be growing. Then when you add that on even distribution of income. The equity market, interestingly, started the year on a very strong note. Key thing is that some operators and some business operators in the economy seem to be bellwethers, like the financial services industry. We've seen a consistent year-on-year strong earnings and strong performance in the financial services sector. We've also seen strong performance in the industrial goods sector, particularly the cement subsector. So some sectors have remained a bellwether, obviously leveraging on the level of liquidity in the economy. So far, year to date, the all share index has increased by 9.95%, almost 10%. If you look at the decisions of the Monetary Policy Committee, which have tried to encapsulate, we've seen an improvement in capital adequacy ratio. We've seen an improvement in liquidity ratio. We've seen a reduction in non-performing loans. Of course, part of the reduction in non-performing loans was a result of forbearance that the central bank granted the banks to extend to their customers, allowing them to restructure some of the loans. Even so, you may see a masking of actual non-performing loans until this forbearance is lifted. And then we can now measure the actual performance of those companies. To further support the risk sector, the central bank reduced the rate it charges on its intervention funds from 9% to 5% and has extended that on 2 occasions, just to make sure that business operators who have accessed central bank windows continue to enjoy sub-market interest rates. In the financial services sector, we are seeing a lot of transformation. We are seeing a sharp and quick adoption of fintech as a tool for providing services. In fact, some of them are actually transmitting into more of fintech entities. Because the challenge is that the competition is coming from an uncommon and an unusual angle, which is the financial service technology sector. So this, in response to that, many banks are adopting the holdco approach, the holding company approach, to allow them be able to use leverage on technology and also provide multifaceted services using each of the subsidiaries as major tool or weapon to play in some of those sectors. We've seen high level of labor mobility, particularly the highly skilled labor. With respect, people have been migrating to Canada and some other countries, particularly those with skills in IT, medical services, have been exiting the country as a result of weak economic performance. The fixed income market, we've seen a bullish run in the fixed income space. Interestingly, part of it is coming from the fact that you've seen there is liquidity in the economy as a result of all those intervention funds that came into the system. And that's manifested in the oversubscription of the last 2 auction of federal government bonds. The FGN 2026 and FGN 2042, we are oversubscribed by 3 times or 300 times and about almost 5 times of the amount on offer. Of course, the implication of that, we've seen a moderation in rates in the fixed income space. On the Eurobond space, the war in Ukraine led to flight to safety where investors were moving to to gold and other metals and dumping even Eurobonds. Most specifically the emerging market Eurobonds. We've seen instances where the yield on some of these sub-Saharan African Eurobonds, including the North African and the MENA countries, Middle East and North African economies, bond instruments have skyrocketed. We've seen where the likes of Ghanaian Eurobonds, sovereign bonds have gone as high as 18% yield. We've seen situations where Egyptian Eurobond and other, Angola, have all suffered dumping by investors in preference for safer environment. Part of this we are triggered by the war in Ukraine, which led to situations where some European banks or Western banks, European and American banks, shut out Russian financial institutions and compelled them to sell down on fixed income and other securities they were holding. So that has led to dumping in the Eurobond space. But interestingly, for Nigeria, Nigeria is still viewed in terms of our Eurobond exposure as relatively stable. So you saw Nigeria came to the market with a 1.25 billion dollar offer at an 8.75%. But eventually the offer was oversubscribed, and then we ended with a cutoff rate, a marginal rate of 8.37%. But be that as it may, an 8.37% yield or coupon on Eurobond on long-dated instruments is still considered quite expensive, because this instrument is particularly not callable. The outlook of the global economy. The Ukraine war, as you may have noted, observed, Russia has pulled out of the surroundings of Kiev and now focusing on Donbass. Donbass is largely a Russian-speaking region, so Russia said they are not going to continue pushing towards Kiev, but rather retreat towards those 2 or 3 regions that Russia had supported to become independent of Ukraine. But those regions are also largely 100% or 90% Russian citizens of Russian extraction. So it is hopeful that the period of combat will gradually wind down, and that Russia may eventually end the war, which they started. And if that happens, we should expect that normalization should begin to take place. We're already seeing that. Expectations of that reflect in recoveries in Eurobond market. We've seen it reflect in moderation in the price of crude oil and other energy sources. So we hope that this trend will continue, and we'll have the global peace will be restored. Dangote Refinery, the president visited it about 2 or 3 weeks ago, and I understand the level of completion is at advanced stage. It's expected that at the minimum, it will cut off some logistic costs associated with importing refined petroleum products to the country. Shipping charges, handling charges, demurrage on those vessels, insurance on those vessels, JT fees, and some of these expenditures may be relieved. We may be relieved of those costs if Dangote Refinery comes fully on stream. Food inflation, like I said, we saw a marginal improvement in food inflation, but that may reverse, because I had mentioned earlier that the Russia, Belarus, and the Ukraine control fertilizer production in the world. They control wheat production in the world, and all this are directly transmitted into food cultivation and food agricultural yield, and possibly food prices, particularly staple food. So we should expect further uptick in inflation rates. Food inflation could go up. At the local level, we've seen a heightening of the security in the country. We saw an attack at the airport in Kaduna, and then the bombing of the rail line in Kaduna, thereby cutting off all channels of all routes, all channels of transportation or entry into Kaduna. We know that the insecurity situation in the Northwest has actually worsened. The likes of Zamfara State is on the throes of the bandits. We're not talk of the already bad situation in the northeast of the country. So these are supposed to have effect on the food inflation. Then on the FX environment, I had mentioned the background under which we're having pressures on the FX. So we think the pressure will continue. Crude production will struggle. We've seen consistent breaching of pipelines by the militants, although that is highly underreported. Though we know that Wike has been pursuing them, but we don't know to what extent that will achieve results across the entire Niger Delta region. So we think crude oil supply will continue to lag behind, and that will continue to exert pressure on our foreign reserve and exchange rates. We think exchange rate will further depreciate in the current year at all the market segments. There are sectors we think should benefit this year. The ICT sector seems to be growing on its own. It looks like it has its own engine that is propelling its growth and is manifesting its several facets of Nigerian life, the entertainment industry, and then what have you. So we think that will continue to grow. Real estate sector, some segments of it will grow. We think because the pre-election year, there will be a number of public works that should favor the construction industry because demand for cement should continue to increase. The telcos, given that they've even gotten mobile banking license, we think they will fully deploy that. They've also, MTN has gotten a 5G capabilities. And as people migrate into virtual work environment, the demand for data will keep increasing. And we think those in the telecommunications sector will continue to see record growth. So our top picks in that sector are MTN and Airtel. Construction, that I've talked about that. Public works will continue in the current year. Governments will be trying to leave some footprint, or at least create an image or impression of the government is working by embarking on road construction and other infrastructure. So we think the construction industry will continue to prosper. The hospitality industry and other sectors may benefit, but we think that will be after the elections because at that time more clarity will be available. But nevertheless, the cement manufacturing subsector should be good investment instruments in the current year. The banking industry, of course, we know the banking system are the ones who are the arbitrators. They stand in between the deficit unit and the surplus units. And no matter how you drive the economy, the banking industry is the one who distributes economic resources. So we think in that role, and given the forbearance that Central Bank has given to them, as well as a volume of intervention funds, which are all channeled to the banks will continue to record good performance. The banks have been succeeding in cutting down on costs, leveraging on technology. So you look at the banking side revenues, you observe that their non-commissions and fees have been increasing, and this will further continue to boost their revenue. So our top picks are State Bank, UBA, GT, Fidelity Bank, and Zenith Bank. Oil and gas sector, the upstream operators are likely going to benefit if they're able to move their crude production to the export terminals. Many of them have adopted virtual pipelines by using batches to take their products to the export terminals. So if they perfect that process, they should be able to take advantage of the increase in crude prices. So our pick is Seplat. The agriculture, of course, supply bottlenecks created globally will mean that attention will now focus on local producers. And those quoted companies in the oil and agriculture sector are actually operating in spaces that are less competitive. The palm and palm-related products, the space they've been operating. So we think, as it stands today, their production is far below the national demand. And we know crude palm oil is banned from it being imported unless you are already one of these oil company, agricultural companies. So they are at a huge advantage, and think they will continue to do well. Official exchange rate, I had mentioned this, that we expect the exchange rate to depreciate across all these market segments as a result of undersupply of foreign exchange against increasing demand for foreign exchange. The local bond market, all things being equal, we think along the line, the central bank may have no choice to increase rates as global central banks are increasing rates. But we also must not fail to mention that we, in our own country, are in peculiar situation. We've seen situations where the Monetary Policy Committee is actually reducing the yield on treasury bills we've seen a yield of about 3.4% for 364-day bills, when inflation rate is 15.7%. So that artificially depressed interest rate environment cannot be ruled out depending on how the central bank feels. The Eurobond market, we should expect some recovery in prices and moderation in yield as the pressures from the war begin to wane. And again, remember that the Federal Reserve Bank is increasing rates. Though the increments are still very tepid, but I think the huge losses that were suffered by the major sovereign bonds will be paid off at some point as the situation in Ukraine improves. Thank you, and God bless you. I can take your questions.
Thank you very much, sir. That was very insightful. We already have some questions here. I'll just go right into it. The first question from anonymous attendee: are we going to see any rise in deposit rate locally, given what is happening with foreign countries raising their rates?
I think, like I said earlier, that we are witnessing an artificially depressed interest rate environment in the country. So that might continue. It pays the central bank and the federal government to have an artificially depressed interest rate environment. The reason is that our Naira is not convertible. You don't have the liberty to just convert and go and invest elsewhere where you can get higher yields. So you are stuck with the local market. So, and again, a higher interest rate environment would mean the federal government would pay much more than they're currently paying as cost of servicing local debt. So I think you can't rule out the fact that the Monetary Policy Committee or the central bank will continue with the artificially depressed interest rates. Ideally, interest rates should be higher than inflation rates. Inflation rates should be the benchmark to set interest rates, but that's not the situation we have.
Thank you, sir. The second question from Inke Manove: thank you for the presentation. Please, where do you see the exchange at the end of Q2, both in the official and parallel market?
It will be difficult to place a bet on what the rate figure would be, but what I can say is that as long as the pressure continues, it will not be solved by borrowing, because you need a flow, and borrowing is one of. So the central bank is struggling to make sure the depreciation is at the very low rate, but it's constrained because it doesn't have the war chest to really defend the Naira. So what I can say is that we should prepare for further depreciation. It will not be appropriate for me to bet on what the rate will end. But clearly, we've not seen the worst is not yet behind us, at least in relation to the exchange rate.
Okay, thank you, sir. What are your thoughts on the Nigerian Eurobond yield at the end of the year, having in mind the interest rate hikes in the US and potential election fears from FPIs?
Okay, as per the yield on our dollar bond, like I said, the last offer was at 8 point, ended at the marginal rate was 8.375% when they started the intentional plan to issue at 8.75%. So the yield on that bond, on the Eurobond, will remain in the current region where it is. Nigeria did not suffer, sovereign bond did not suffer as much as that of Ghana or even Egypt did, because it's expected that with about 39 billion in foreign reserve, that Nigeria is still buoyant enough to meet its obligations. When you now look at a local investor investing in Eurobond, the key thing you have to ask yourself is that I've talked about exchanges, which means that if you invest in Eurobond, you are kind of insulating yourself against further depreciation of the local currency. Second factor is that yield on local currency instruments is not even as high as the Eurobond yield. So if you invest in Eurobond, you will be achieving two things. You'll be getting a yield, those below inflation rate, but those below local inflation rate, but higher than local currency yield. And again, you will be insulating yourself against further depreciation of the local currency. So that's what I have to say on the Eurobond.
Okay, sir, there's another question from God's Time James. Please, what is your opinion on the correlation between the monetary policy of the CBN and the fiscal policy of the federal government?
Well, what I would say is that the fiscal policy of the federal government seems to be quite weak. The only fiscal tool we seem to hear of is the budget, which is done an annual ritual. And the budget itself, if you decompose the budget, you realize that, look, in terms of revenue projections, we've never really done anything to achieve our revenue projections. Last year, the total that we achieved was something like 6 trillion in terms of revenue. Because by the end of November last year, when the last figures were tabulated, we had only gotten a revenue of 5.5 trillion. So, and this year we have, out of leap of faith, we've now increased to 10 trillion as expected revenue. So I think in terms of the effectiveness of the fiscal tools, I think it's been relatively weak. So what we have seen is an overdrive of the monetary tools or monetary authority instruments. So we've seen a situation where unorthodox monetary tools have been deployed in places where fiscal tools have been deployed. We've seen a situation where the monetary authorities have taken decisions that mimic the decision that fiscal authorities would take. For instance, the decision of the monetary authorities to ban the sale of forex to some items is basically what should have come from a trade policy where the fiscal authorities would have banned the importation of those items. But the monetary authority does not have the right to ban importation. So what it did was ban access to FS to import those things. So that's why I said, look, we have seen a situation where because of what I might call the absence of fiscal authority, the monetary authority is now playing their wing using some creative tools.
Thank you, sir. There's a question from Olalere Babashola. S&P rating of Nigeria at B- is lower than Egypt at B+. How do we explain Egyptian Eurobond depreciating more than Nigeria's?
Well, basically what happened was they looked at what is the exposure of the Egyptian economy to the Russian crisis vis-a-vis Nigeria's exposure to the Russian crisis. Remember, Nigeria is an oil-producing country. Egypt, it does not produce. So countries like Egypt were far more exposed to the Russian crisis with no spill-off benefit. Ordinarily, if Nigeria had put its house in order, we should have been, as I said earlier, we should have been talking of Ukraine oil windfall. So Egypt was not in that position. Egypt, part of the Egyptian budget is funded by donor agencies, donors from particularly US. So a situation where the US and some of these Western economies' attention is now diverted to supporting a war in Ukraine means that the resources that would have been given to Egypt would have been denied them. So there was concern by investors that Egypt was in a more precarious situation as of the war than Nigeria was. And that's why they reacted that way when it comes to their Eurobond instruments.
Okay, from Olalere, GTCO has depreciated greatly of late. Do you see this as market correction or market overreaction? Has it bottomed in your view? How long do you see it taking to recover to the 30 Naira region?
I think what market operators or investors were looking at was, it looks like the growth in GT stalled in the 2021 financial year. So market operators or investors were actually reacting to that. Whether it has bottomed or it will recover or weaken further will depend on the first quarter results that will come out of GT. If the new management and the new holdco structure they have adopted begins to present reports that are salutary to investors, then the market will react positively. So let's wait until we have their Q1 result. Then we will now see whether the stall in their growth is going to continue or they've turned the corner.
Okay. Thank you, sir. Aside GT, Zenith, and Fidelity, which other stocks in the banking sector should we look at?
Well, what we have done is to put them in our order of preference. There are still several others that depend on your investment objectives. Are you investing for dividend yield? Are you investing in for capital appreciation? Are you a long-term investor? Are you investing as you want to invest in a gate age asset so that the next 20, 30 years you're not worried that the company could change in materially negative on the negative. So if we know your particular investment objective, we'll recommend not just banking stocks to you, we'll also recommend other stocks to you. So you can reach us after this, and then we can speak to you and appraise your investment appetite, your investment objective, your cash flow, your station in life, and then we'll be in a proper position to advise you on not just the banking stocks, including other investable instruments.
Okay. If Dangote Refinery is able to commence operation this year as projected, to what extent do you think will help reverse the crumbling value of Naira and FPI in Nigeria?
Dangote Refinery will not have any effect on the Naira exchange rate. Neither will it have any effect on foreign direct investment in the country. In the first place, Dangote Refinery is largely a Nigerian entity, not a foreign investment entity. So it won't be a proof of concept to foreign direct investors that, look, this is a good investment climate for foreign direct investment. As relates to the exchange rate, Dangote Refinery will continue to buy crude oil in dollar. So there are two things. If they decide to agree to sell refined petroleum to Nigeria in Naira, the Nigerian government central bank will still have to sell dollar to them so that they can pay for the crude. So it wouldn't eliminate the need for foreign exchange to meet importation of refined petroleum products. What we will gain largely would be in terms of logistic costs, which I mentioned in my presentation. Costs like shipping charges, handling charges, JT fees, and stuff like that will be drastically reduced with Dangote Refinery coming on stream.
What are your projections for inflation in the medium to long term? And how will they tie into assumptions of a future interest rate hike by the monetary authorities? What does this portend for economic growth?
My take on inflation rate is that in the month of March, we should see an inflation rate that is worse than 15.7%. I've laid a background on why I said the inflation rate will increase further. I talked about the energy costs, fuel costs, diesel costs, those things had effect. Transportation costs all had effect in the month of March. And some food items are also recorded increases. In fact, we've seen the electricity tariff have increased. We've seen even the likes of the cable TV service provider increasing their tariffs. I also understand the telecom companies are also increasing their tariffs. All these things are affecting our pockets, and they affect the consumer prices. So I think we should expect that to reflect in higher inflation rate at the minimum in the month of March and April.
Okay, in the last 2 decades, why is it that profit making now occurs more through investment in financial instruments rather than through traditional commodity production and commerce? Follow-up question. What will be your expert advice between investing in financial assets or in the real economy?
Well, the key thing about the Nigerian market economy, we have to recognize that the real economy is really challenged by what we call paucity of infrastructure. What has happened in an economy where basic infrastructure is lacking is that service industry becomes the bedwetters. The simple reason is this: a bank with beyond providing energy supply to their head office. In fact, the banks are even telling you now they can close by 5 p.m. And if you still have any work to work remotely, the banks are not saying you don't even come to the office now. do your transactions online, run your own generator in your house or your office, and operate from your office to be serviced by us. So the service industry, the banking industry, are actually in better position to navigate through an economy like ours where basic infrastructure is lacking. Because for you to have real sector economic growth in the real sector, you need to, as a matter of fact, have supported infrastructure that will make your cost of doing business cheap and the ease of doing business is better. But we don't have that. And that's why if you look at a place like Lagos or most other, in fact, not just Lagos, you will observe that the manufacturing sector used to be more vibrant in the 80s and 90s. Many of them cannot operate because of high energy costs. But the service industry, because their energy need is minimal compared to the manufacturing sector. So that will now explain to you where to invest in an economy where you don't have, we've not done the heavy lifting, we don't have the supporting infrastructure. The service industry will, in most instances, outperform the real sector, the manufacturing sector, the productive sector. So I think that explains where I think investment should go in such an environment.
Okay, so we'll just take, I think, one more question, while the others will be answered offline and sent individually. So the last question is, what is prospect of health industry sector? You didn't touch this industry.
I think the health sector has a very strong prospect. We are seeing private sector oriented tertiary health services in the country, particularly in places like Lagos, Abuja, and Port Harcourt, where major referral that are served as major referral centers. The public health institutions have suffered because of lack of investment, but the private sector is taking the lap from public sector institutions. So I think that sector will receive more boost, particularly with the depreciation of the currency, the higher cost of going on medical tourism to India and other countries. In terms of skills, we have reasonable level of skills locally, but in terms of supporting infrastructure, we are just building that. And again, technology is also helping now. We now have situation where Nigerian based medical service providers can work with their foreign counterparts and even render services without you physically traveling to those countries. So I think it bodes strong growth prospects. Remember, the population is going to about 206 million, and that sector is largely underserved.
Thank you very much, sir. Thank you for your time. Like I earlier mentioned, the rest of the questions will be answered offline and the individual responses will be sent. Please note that this presentation will be shared after the webinar session to all participants, because we have a lot of people requesting for that already. So we would send it after this presentation. So thank you very much, sir. Thank you for your time. I'll be calling on my colleague, Mr. Okudili, to take the vote of thanks.
Thank you everyone for participating in this, our first webinar for this year. We want to make sure that every quarter that we'll present to you, a section, a webinar section that would kind of mimic what we just said today. And we are trying to ensure that as much as possible, we present to the investing public adequate knowledge that will guide their investment decision. We are pretty impressed with the turnout today, and we hope that by when next we call on you, we'll be able to come and listen to us again. Thank you very much.
Thank you, sir. Thank you, everyone. I hope you find this session very impactful. I hope you've been able to learn one or a few things which will help you, our investors, make very important and good decisions when investing. So Thank you very much. We have come to the end of this session. We hope to have you the next time. Thank you so much for your time, and then enjoy the rest of your evening. Thank you.